Building wealth takes time. It takes patience, and it takes the discipline to invest for the long haul. Don't get caught up in get-rich-quick schemes. They rarely work. Instead, focus on steady, consistent growth. That's how you build real wealth. One of the best ways to invest for the long term is in the stock market. Now I know what you might be thinking. The stock market can be scary, but over time the stock market has always gone up. It's a powerful engine for wealth creation, especially when you invest in solid companies. When choosing companies, I always look for businesses that are built to last. And one sector that I always pay attention to is banking. Banks are the backbone of our economy. They provide the capital that businesses need to grow and thrive. But not all banks are created equal. That's why it's important to know what to look for before you invest. In the following sections, I'll walk you through the key factors to consider when analyzing banks for investment. When most people think about company performance, they look at revenue growth. Is the company selling more products or services? But with banks, it's not that simple. Revenue growth alone doesn't tell the whole story. For banks, the first thing you want to look at is loan disbursement growth. Are they lending more money? That's how banks make money, by giving out loans and earning interest. A healthy bank will have consistent growth in loans. But here's the catch. Giving out loans is risky business. What happens if borrowers don't pay back their loans? That's a big problem for banks. It's called credit risk. That's why it's crucial to look at a bank's non-performing assets, or NPAs. NPAs are loans that haven't been repaid. A high level of NPAs is a red flag. It means the bank isn't managing its risk well. So we know that banks need to grow their loan book, but they also need to manage risk. But how do we measure a bank's efficiency in doing this? That's where ROA comes in. ROA stands for return on assets. It tells you how much profit a bank is generating for every dollar of assets it holds. A higher ROA is better. It means the bank is using its assets more efficiently. Some investors look at ROE, or return on equity, but I prefer ROA for banks. Why? Because ROE can be manipulated by taking on more debt. ROA gives you a clearer picture of the bank's core operating performance. Another important factor to consider is a bank's net interest margin, or NIM. This is the difference between the interest rate a bank earns on its loans and the interest rate it pays on deposits. A higher NIM means the bank is making more money from its lending activities. Finally, let's talk about CASA. CASA stands for Current Account, Savings Account Deposits. These are the cheapest source of funds for banks. A bank with a high CASA ratio is in a strong position. It means they have access to low-cost funding, which boosts their profitability. Now that we've covered the key metrics, how do you know if a bank is a good investment? One important measure is the price-to-book value ratio. This compares the bank's stock price to its book value per share. Book value represents the net worth of the bank's assets. A price-to-book ratio of less than 1 means you're buying the bank for less than its net worth. That can be a sign of undervaluation. On the other hand, if a bank is able to issue new shares at a price-to-book ratio significantly higher than 1, it means investors are willing to pay a premium for its shares. This is a positive sign. It shows that the market has confidence in the bank's future prospects. Remember, investing is a marathon, not a sprint. When it comes to banks, look for institutions with strong fundamentals, a track record of profitability, and a commitment to managing risk. And if you can buy them at or below book value, even better.